Welcome back. You're watching Global Investor. Still with me in studio, Nick Kunze, joining us on the line to discuss Citadel's Global Equity H4 Fund of Funds as fund manager and head of fund research at Citadel, Yolanda Naude. Yolanda, thanks very much for joining us. So if somebody invests in the Citadel Global Equity H4 Fund of Funds, what are they investing in?
Stephen, good evening to yourself, your viewers and listeners. For investors in this fund, they get, in essence, a style-neutral, benchmark-aware global equity fund in which investors can invest with rands or in rands. So that's the benefit of this fund. You don't have to convert to dollars, you can invest with rands.
Why a fund of funds? Why would an investor go for this rather than going for one of the underlying funds by themselves?
We pool the assets of all the individual investors, so we have the benefit of bulk assets, and we negotiate fairly good fees on behalf of our clients, and we give all of that through to clients on the first hand. The other factor that's important is that we can manage specific style risks. So an investor can choose any individual fund, but then you have to be aware of the specific style, for example, growth or momentum or value style that you are exposed to. In this fund, we blend them together in a style-neutral way, and we are benchmark aware in order to ensure that the fund doesn't deviate significantly around the benchmark, but that we can give the ultimate investor here the asset classes returns over time.
Okay, so, I mean, there are three main funds that you're invested in. That's Peregrine, Nedgroup, and Orbis, and all of their global equity funds. Do they have significantly different styles from each other? How do you go about selecting those managers?
Yeah, we have a list of around 10 global equity managers that we have approved in due diligence. The beauty about the Peregrine Global Equity Fund, or Global Greats, its name has changed, is that is really a blended fund. It is really blending value growth and a bit of momentum. It is looking for about 40 Fortune 500 type companies. So it's all about strong brands and not necessarily about paying a cheap price for it. So yeah, with this manager, you do get a little bit of growth and the manager is willing to pay up a bit. And this portfolio ultimately should benefit from a compounding effect over the longer term of these great companies. So that we see as the core of the portfolio. We then blend that with the Orbis fund. Now, Orbis is not new to South Africans, and you know that with Orbis you don't necessarily have a lot of key man risk because it's managed by great teams, both a sector team and a global team, and then their portfolio construction teams. Here you get a global diverse portfolio of undervalued and often, in our view, contrarian type stocks. And despite that big fee that investors pay if they have outperformed for a prolonged period of time, it is a fund with a great long-term track record, but it's for the patient investor and for an investor that's alert. And the reason I say that is because over time, Orbis can outperform significantly so by 10, 15, 20, 30 percentage points over rolling 1, 2, 3, and 4 years, but it can also underperform. So what we do when we manage this fund is we try to avoid the normalization of the excess returns. So I'll give you an example. The Orbis Global Equity Fund is outperforming over the past 2 years by cumulative 20 percentage points. It's phenomenal. The fund has done really, really well. They've benefited from the IT exposure, etc., and some of the FX calls have also come through. For us, that's a wonderful outcome and a beautiful problem to have. But we are now slicing off the top. We are now taking a bit of profit on that excess returns as we see it, and we have introduced an index fund which will also bring down the total cost of the Citadel Global Equity Fund. So we are careful when we introduce Orbis into a fund. Be careful of when you go in. Try to get into a fund, into this one specifically when it's underperforming. And then when it has done very well, skim off the top, take a bit of the cream off the top and do something else with that money.
Okay. Nick, your thoughts on the strategy here, so the style-neutral strategy they're aiming for, but also around Orbis and taking money off that, particularly into the iShares World Equity Index.
Yeah, I mean, it's especially in this day and age with market neutral is the way to go. I had a question for Yolanda, though. Yolanda, hi, just a question regarding just on the fees. As active fund managers, we've taken a lot of stick recently with the fee structures, everyone piling into ETFs and all the rest of it, and everyone happy, rather paying as minimum as they can. Are you noticing with fund of funds, with the layering and the fees, have you had any sort of backlash against it or not?
Yeah, we do get resistance to some extent, and that's understandable because it's a global phenomenon.
Yeah.
And South Africa is not escaping it at all. That's part of the reason why, after the significant outperformance of Orbis, that I'm introducing the iShare, for which we pay collectively, because we have bulk money, we pay 18 basis points, or below 20. So that's going to reduce the TIC, the total investment charge of this fund, fairly significantly so over time. So we try wherever we can to get the best possible fee, and the beauty of bulking is that we can invest in these underlying funds as institutional investors at a yield or a rate that the individual investor can't invest in. But absolutely, you're right, there's pressure on fees, and we are doing everything in our power to also reduce fees for the client.
And you're looking again at TIER down to about what?
Ultimately, if I can get it down to about below 2, I would be happy.
Yeah.
Would that be a good outcome, Nick?
Yeah, yes. I mean, look, it's obviously the TR, what it was of 2.53% is a lot, and it's obviously going to impact performance as well. And half the performances these days with fees, and unfortunately, it's the talking point of the moment. Everything's about, we've been whipping boys for a while with active fund managers and moaning about the fee structures. So it's definitely a step in the right direction.
Yolanda, your benchmark is the MSCI All Countries World Index, and you have been lagging that. Is that a factor of the fees that are layered onto the funds?
Yeah, if we look at it in net terms, over the past year, the fund is 40 basis points behind the benchmark. So if we were to look at that on a gross basis, and you were to add the 2.5 to the 6.8, then we would have had nice outperformance. But we have to look at it on a net of fee basis, because that's what the client is ultimately getting. Part of the reason why we have underperformed by 40 bips over a one-year period is the fact that we had limited exposure to emerging markets. We have had exposure indirectly to emerging markets via the Peregrine Global Great Fund, but it wasn't enough because, as you know, the emerging market equity sector as a group have outperformed significantly so over the past year and 18 months. So if we have had a little bit more of that, we would have benefited. And emerging market equities aren't expensively priced. They're sitting on a PE of around 16 at the moment versus the globe now after the sell-off in Feb at 18.5. So they're not expensive, but they have outperformed. So I'm looking for a bit of a pullback in emerging market equity prices, and then I'm going to introduce probably an emerging market equity manager in here.
How underweight emerging markets are you relative to the benchmark?
The benchmark, it depends on a day-to-day basis in terms of actual exposures. As at the end of February, emerging markets was 12% of the MSCI All Country World Index, and I was at 7%.
Okay. So talk us through the RAND. So this is a RAND-based fund. Investors are investing RANDs. And obviously last year was a tricky one when the RAND rebounded so strongly in the final quarter of the year. And that must have held back not only your performance, but also the performance of the benchmark when translated back into RANDs. And I suppose that's something that investors just have to deal with.
Yeah, we fortunately offer another fund, and that is a global equity fund hedge back to RANDs. Now, that is a beautiful asset class because in the hedging, you get the additional 5.5% to 6%, depending on the interest rate differential. So that fund has done really great despite the RAND strength. Here, as you mentioned, the index is as much impacted by RAND strength as the fund. And if you look at it over the past 12 months to the end of February, global equities were up about 18 and the RAND strengthened by about 10.8 or 11% versus the dollar. So absolutely, yes, a significant portion of the offshore US dollar-based equity returns have been negated by the RAND. But relative to the benchmark, it's not an argument because the benchmark also moved, as you know.
Now, of course, you would be hoping that investors would be coming in while the RAND is strong as it is at the moment, because then they can benefit in the other direction.
Yeah, and our internal models are now showing fundamental RAND fair value at around 12.8 at the moment, and this afternoon we were sitting at 11.80, or the latest that I looked. So if you take all the economic fundamentals, for example, inflation rate differentials and commodity prices, etc., into consideration, we think the range should be around about 12.80. So we do see and think it's a good opportunity for South African investors to still diversify offshore and invest in a fund of funds like this, where yes, the fee isn't dirt cheap, but we manage the risk for the client around style and around the benchmark, very specifically so.
Yolanda, how nimble can you be when there are changes in the market to take advantage of? So you said you missed out on the emerging markets rally last year. Are you able to take advantage of something like that, being a fund of funds? Do you have to go to the underlying fund managers to get them in step?
Yeah, easily, because fortunately the fund size is 580 million, so we are rand. So we're not swamping any of the underlying managers. We can be nimble, and if I want to take a strategic view on an asset class and just go in at the right point, I can go in with an index fund, which is easy. Alternatively, we have emerging market actively managed funds available on our approved fund lists internally, which I can choose from. So I have 3 choices currently that I can choose from if I decide to invest in emerging markets. And I'm really hoping for that opportunity to come, because I think there's still an opportunity in EM.
I mean, we were chatting in the first part of the program, Nick, and you were also seeing opportunities in EM. Would you want to be invested in a fund that has exposure to that?
Well, exactly. It's exactly what we're speaking about. And you said to me, where would you be looking to put money now? And my first answer was EM. I think London's exactly right. A lot of the sort of the top 6 countries in the world they're all looking a little bit expensive. They're not cheap anymore. And emerging markets, they have run a little bit. They're not cheap as they were, but they certainly offer much better value, I think.
Yolanda, in the Orbis and the Peregrine funds specifically, and you chatted about Orbis a little bit, but they were cushioned by the strong rand, or from the strong rand towards the end of last year, purely due to their exposure to financials, tech, consumer discretionary stocks. Are you seeing more strength ahead for those sectors? Where are you seeing the value or the opportunities going on into 2018?
At a skill level, is that, Stephen? Is that the question?
Yes.
There's almost no sector internationally that is cheaply priced anymore. And you can understand why, because the equity markets aren't cheap anymore after about 10 years of a bull market. So it will be all about individual stock selection within sectors. I think financials may still have some tailwind as a result of the tax changes in America. Energy has lagged significantly so, and the oil price has rebounded, so perhaps there's an opportunity there. But I'm not a sector specialist, so that's why we allocate to global managers, and we rely on them to survey the world and then look at where they find the stocks. And they typically don't look at sector views per se, so it's more of a bottom-up. We like a specific stock, and it just tends to be in a specific sector. So the sector allocation is almost a bubble up of the underlying stock selections that the managers do.
And looking at some of the stocks that they've included in the portfolio, Nick, you've got Charter Communications, Rolls-Royce, Alphabet still there, despite the strength that you have seen there. Airbus, your thoughts on the kind of makeup of those top holdings?
Well, funny enough, we've got an offshore fund as well, which has got very similar to this. So it's the usual suspects. But I mean, Rolls-Royce has had a great run recently. There's Alphabet, of course, is the Nasdaq hit a new high yesterday. So it's a very well-weighted portfolio, and I actually quite like some of these shares. We've got a couple of them as well.
I think that the reason also why people will recognize it is because the Peregrine Global Rates Fund is the main fund here with the largest allocation, and it is really about those Fortune 500 companies.
Yeah.
So the average investor should be able to recognize these and feel fairly comfortable from at least a knowledge perspective in terms of I've heard about it, I know something about it, and it's not something completely out of the box.
I see. Just out of interest, I see. Did you exit Berkshire Hathaway?
No, there's still the fifth largest stock.
Is it? Okay, got it.
Yeah.
Okay. Yolanda, we have to leave it there for just now. Hopefully the rand will play in your favour this year, and we can chat again in a year's time. But thanks so much for joining us.
Big pleasure. Thank you, Stephen. Thank you very much. All the best.
Thank you. That's the show for this week. Do remember to tune in tomorrow at 10 o'clock when